Hi, I'm Sabrina. I work with homeowners who want to make smart decisions without pressure, confusion, and tonight isn't about selling you anything. It's about thinking clearly. Most homeowners don't make bad decisions because they're irresponsible or they're careless. They make them often because they feel rushed. A lot of information out there is very loud and not personalized. And rushing large financial decisions usually cost more than waiting. So tonight we slow it all down. This week, it's been such a busy week. So you're wondering, should I refinance? Should I use equity? Should I wait? Am I missing something? So you are in the right place. This is a calm clarity space. We look at numbers without fear and without pressure. So right now, again, homeowners are hearing a lot of mixed messages like don't touch your rate, especially if you're at a 2 or 3% rate and you had refinanced already back when we had that low rate boom, 2020, 2021. I know you all remember it. Um, or you're hearing tap into your equity. So finding out how much equity you have is important, and you should do that time to time. I highly recommend it for peace of mind as well. Or you're hearing rates are changing. Don't really know if you should refinance, if right now is the right time for the refinance or whatnot. So I'm here to help in a calm, consistent way. Okay. So none of that matters though without context. So we want to look at the bigger picture. So without any context, advice really feels risky. Someone might have that 3% rate, but be carrying credit card debt in the amounts of 20 or 30%. Okay. Right now, the cost of living is very high, and I think a lot of us are really feeling it when it comes down to our debt. So the problem isn't rate, so it's just the lack of clarity. So before touching your mortgage, I like to ask three questions. How long are you going to stay in the home? What problem are you solving? Could be something simple as lowering the monthly payment. Um, could be other things. Does this improve your long-term position? So again, looking at the bigger picture, how long are you really going to be in the home? It is a case by case basis. Everybody's different. We all live different lives. We have life shifts here. We have children. We might be in a stage where we are caring for elders, might be getting married, might be getting divorced. There's a bunch of stuff that comes into play when it comes down to these decisions. All right. So equity is leverage. It's not free money. It can absolutely lower stress. It can consolidate debt. It can also increase risk and it can slow wealth if it's misused. All right, so it's neutral. It's not good, it's not bad. However, knowing and being informed of how it works is super important. So it truly depends on strategy. So if you want to eliminate that 20 or 30% in credit card debt that you have, it can be absolutely powerful. If you use it emotionally without math, it can cost you long term as well. All right. So refinancing makes sense when you reduce the total cost, you shorten a payoff timeline, you eliminate high interest debt, or you're staying past a break-even point. So yeah, again, refinancing isn't about chasing the lower rate. It's about restructuring and with intention. It's about your total interest that you're going to be paying off the long run, your timeline, again, how long you're going to be in the home, reducing stress here, which can come with that month-to-month payment or payments, and strategic restructuring. So people obsess over the rate, But again, rate goes hand in hand with cost. So you have to look at your cost and then you look at the rate and how much you're saving each month. Well, I've helped clients save total interest over time, even though their rate didn't drop automatically. All right. And sometimes refinancing does not make sense. Sometimes the smartest move is no move. I've advised people to stay put, and that was the best decision for them. So, not making a move is still a strategy. Honestly, it helps you with peace of mind too. So this can happen when you're moving soon. You're just reacting emotionally, so making quick decisions. I am not a fan of quick decisions. I like to take my time and evaluate all the pros, all the cons, and then weigh it out. And even then, sometimes it takes months on end to come to a decision. Um, so if you haven't calculated recovery time and where you're actually going to break even, or you're just chasing a rate here. So I've helped clients that, yes, back in 2021, I've helped and we've refinanced for a lower rate, only to find out they move within a year later. And they were just like right at their break-even point to where maybe they did not need to refinance. So life happens, things change, and we got to shuffle sometimes. So, right. Now, recast versus refinance. So I say this often on LinkedIn or here and there, I hear about it. People often ask, what is a recast? So a recast is when you put that lump sum back to your mortgage. Now, not all lenders will allow for this, but most will. So you take that lump sum that you have. Say if you got a bonus or it's tax time, or maybe you're getting funds from a lawsuit, a payout of some sort, and you want to just lower that monthly payment in the mortgage. And most lenders will allow you to take that lump sum. Obviously, it has to be a certain amount, say over 10,000, or depending on the lender, you'd want to ask, absolutely. You take that amount, you'd put it on the mortgage, and it does come with a small fee. You want to check into that and check what that is. Normally, it's not that bad. And then what they do is they can apply that payment and restructure and re-amortize the rest of the payments to where you have a lower payment in the end. So, that's a nice option. I have advised people towards that option as well. But also refinance is a really great option too. So refinance, lowering the rate, so getting into a new low interest rate, you can lower the term and the rate. So lowering the term, which would cut down to, say, if you have a 30-year, cutting to a 50-year or even an 8-year mortgage. I like to utilize this most on clients that are retiring or want to come up with a retirement plan. Maybe they have a business. They are planning their way out, just getting things, finances taken care of, and taking care of their mortgage is one of them. So I'd love to put different options together. I can absolutely go as low as an 8-year mortgage, with the tools that I personally have. Now, obviously, every lender, every broker has different tools here and there. So you want to consider all the options and look at the rate, look at the cost, and just make sure that it's all going to make sense. So this is educational only. I will let you know it is best to talk to a financial person, advisor, broker, lender before you make any decisions. So I will tell you that first and foremost. This is just my expertise and what I've came across here. Right. So break even. So break even determines if a refinance is actually going to make sense. So here's what a lot of people do not calculate. So break even is your cost divided by your monthly savings. So, for example, So say if refinancing cost 6,000. Just gonna do this simple math here. And you want to figure it out yourself. You can actually use your calculator. So simply just put 6,000 there. I don't know how clear that's going to come out on there, but anyway, 6,000 divided by your monthly savings. So say if your payment's 2,900 and you're going into a payment that's 2,600, or say if the payment's 1,600 and you're going into a payment that's 1,300. So you're overall lowering that monthly payment down by $300. So you just divide it by 300 and you come up with 20. Okay. So 20 months is how many months that it's going to take you to recoup the costs, those closing costs. Now, this is important because say if you're only going to be in the home for a year, 12 months, it might not make sense if you leave before that 18-month mark. Um, you know, that's the thing. I mean, some situations I have seen that people do for the monthly savings, but maybe they're getting some sort of funds or something that's going on, or they have a plan to purchase a new home, or I mean, family changes are very common. So I do see weird situations where, well, not weird, but say if they're inheriting a home or they have a plan, or maybe they have another home and they're just kind of like reorganizing things. Maybe they're turning a home into a rental, maybe they're not. Life happens, like I had mentioned, and these changes can come about. So sometimes it makes sense, sometimes it doesn't. Obviously, we don't always see the full picture as brokers or lenders. You know exactly what's going on. So what makes sense again to you might not make sense to somebody else. So yeah. And absolutely, if you stay 5 years, that would absolutely make sense. All right. So I want to show you a tool that I actually coded myself. Very proud. All right. So this is the break-even calculator. So as you can see, I already have an example up there from earlier. Let's change it here. Okay. So this is the exact example that I went over. So your current monthly 2,900, your new monthly being 2,600, and that's $300 in savings. And we'll say your closing costs are 6,000. So as you can see here, your break even comes out to 20 months. And then actually have it broken down in years as well. So, and the monthly savings is right there. All right. So this works different ways. So we'll say 1,600 and we'll say 1,300 is the new monthly. Again, keeping up with that $300 savings. And well, this time we'll say closing costs are, um, I'll say a little bit more. Say we're using a different lender, or you have different circumstances as well. So as you can see there, it can look different with different lenders, different brokers, what options you have there, cost rates. It's important to kind of know exactly how to calculate these things. That way you can absolutely know that what you're doing is going to make sense. So in this scenario, you can see it's going to take 26 months. That's like a little over 2 years, okay? So maybe this is like a trusted person that I like to use. Um, Obviously, cost looks different. I always explain that rate and cost go hand in hand. You want to make sure you're at something very comfortable. Now, pricing can look different with everybody, and it's a case by case basis. Absolutely. After running tons of refinance scenarios for clients, I have seen this first and foremost. All right, so we can do a different example here. So say we're coming up with a $200 saving. So we'll just say 1900 and our new payment 1700. And our closing costs are pretty good at 6000. So that can be 30 months there. So that's um yep, about 2.5 years. So that may or may not make sense with somebody. Now, I also have created another break-even calculator as well. Make it a little bit bigger here. I forgot I can do that. Okay. So, oh, this is awesome. Okay. So we'll say that, just gonna delete this out here. Say you have your mortgage, plus you also have debt. This can be anything in the respect of credit cards. I've seen home equity loans. I've seen home equity lines. I've seen installment loans, lines of credits, car loans, um, you name it. So if you have debt, I mean, debt is debt. And if you're paying high interest rates, or even if you're not paying super high interest rates, you might want to consider because, say, your expenses are very tight because the cost of living is very high right now, which is very common for a lot of people. So you're definitely just wanting to lower that monthly to have some more peace of mind, more cash flow, and that is fine. You can definitely leverage it that way. Um, clients save a ton on the monthly, and then also they end up paying their home off quicker too, which is nice. Coming up with a great plan is always a good thing to do. So back to our example. So we'll say our mortgage here is about 1200. Okay. Say we're paying debt, we're paying about, we'll say 900 in debt. And that's easy to do between credit cards, loans, installment loans, even your car note. Um, and say we're going to refinance all that, okay? We're going to do a refinance and pay off debt. And your new monthly payment, maybe it doesn't save you too much on the initial mortgage. We'll say 1150, but it does save you. Now, these numbers are all hypothetical, so I will let you know that. Obviously, it looks different for everybody. That's why I first and foremost recommend talking to a financial advisor, financial person, mortgage lender, broker, anybody first, because that's going to be your most important thing is to run those specific numbers tailored to you first and foremost with what they have. Because there are different options out there too, like home equity loans, or lines of credits, just depending. And I can go into that on another session. Okay. So we'll say closing cost here are going to be about, we'll say 9,000. All right. So as you can see here, this break even is going to look a lot different because you are consolidating a lot of debt, and that's 9 months, so only 9 months to take care of all that. I've had clients that are going to be making a different sort of move in the future, say in like a year or two's time, whether it be like a new home or maybe a different living situation. And this is really worth it to them to do that because it can improve credit. It can have that effect because you're paying off and you're paying off those high interest credit cards or close to their limits. When they're close to their limits, that does affect credit. Um, so it can definitely help. And I've seen it help too. And I'm just gonna flip over to the amortization tool I had created. So Let's see here. Okay, so our new monthly payment is 1150. We'll say I'm just gonna do this all hypothetical because um I don't have good numbers in front of me now. So okay, so we'll say our mortgage balance. This will be like a completely different scenario. Okay, so our mortgage balance is we'll do new loan with the new loan that we are consolidating debt. We'll actually put it at 190. All right. We'll say our new interest rate is going to be 5.8, hypothetical, 30-year term. So say we just freed up and we paid off a lot of debt and say we're saving, we'll put it out there like $500 a month, okay? Now, if we take our new loan amount, so this 190 is including our new loan. So this is including our payoffs. So say if you had like, for example, 30,000 in credit card debts, um, or whatever the case may be, and you're consolidating it and you're doing this refinance and you're just consolidating it, your loan amount is going to go up, which can be scary to a lot of clients. But if you look at it in a different light, where you are in control of the mortgage and in control where you can actually pay off your mortgage and total debt off faster, this will make sense. So 5.875, 30-year. We'll say that extra 500 that you were paying, you just put it to the mortgage, okay? So what does that do? This is a 30-year. This turns it into a 15-year. And you save all this interest, as you can see. All right. So yeah, so by doing that, you can definitely pay off and come up with a strategy. Like I had mentioned, it can really help those that are retiring and want to come up with a plan. And I always say it's better to be in the habit of putting more on the mortgage anyways. And then you let your foot off the gas and you can always pay less if there's a month where you need the extra money, you're struggling or something comes up here and there, or you just want to kind of save, you can absolutely do that. Um, we'll say you want to keep that extra 300 for whatever, and you only want to put 200 on the mortgage. You would still get it paid off 9 years sooner by putting 200 on this. Well, I created this tool, kind of versatile, so you can also look at what biweekly payments look like. Sometimes it's easy for clients to just do a biweekly payment, and that extra that goes on would end up paying off 5 years. So there's definitely different options out there when you look and you know how to use these tools when it comes to amortization, break even, overall refinancing in general. So, um, clarity over urgency is the most important thing at any time. Rushing can be expensive. You definitely want to calculate these numbers first and foremost and know how to use these calculators. Um, context matters. You got to look at the long picture. Um, you have to look at different things that might change in your life. We all have different changes that come about. Life happens. Kids get older, kids move out. Um, we're all at different stages here and different timelines. Um, so yeah, again, looking at using that equity as leverage or just peace of mind by staying put. Um, don't react, don't make a decision right away. Take your time with these decisions. I'm a high fan of that, so or huge fan of that. And then break even and amortization. So, yeah, that's all I have for today. And I hope everybody has a great evening, a great rest of their week, and I hope this helps you. If not, feel free to share with a friend or a family member that that it could help. All right. But thank you so much. I'll be on again here next week for the next topic. All right. We'll see you later. Bye.